my background focus is in education. I taught calculus, physics, and chemistry for 11 years and then became a high school principal for 23 years. I never stopped teaching, however, even as a principal. We could not find a calculus teacher. We're a very small high school, and nobody that could do calculus wanted to teach at Genesee schools. So I taught calculus 1 hour a day my entire career as principal. Uh, I'm pretty good at maintaining order, and I'm pretty good at fitting what I want to say into the time that I have. So I will try to leave 15 minutes or so for questions. I want to get to the portfolios that you folks sent me because I want to talk about them a little bit. And I would like to get through most of what I've prepared to talk with you about. Let me tell you that I find when I visit chapters that the biggest problem that chapters and clubs have is that they can't see the forest for the trees. And I want to kind of extend that analogy just a touch. The trees are individual stocks. The forest is your portfolio. And I find that most of you, whether you're managing a personal portfolio or a club portfolio, or whether you're in 5 bigger clubs, you're still focusing on individual stocks instead of how that collection of stocks fits together and what that collection is doing. It's great that I have a 5-bagger in my portfolio. But if my portfolio is losing to the market, not doing as well as the general market, then while that 5-bagger helps, I'm still not doing my job. Is that making sense to you in a very generalized way? I'm using Bloom's taxonomy right now that they taught me way back in educational school. And that was for exposure. We're going to come back to the forest of the trees a couple of different times. And by the time we get to your portfolios, I hope you won't be taking offense at some of the things I want to direct your attention to in your portfolios. No investment recommendations are intended. This is an educational demonstration. I'm not the boss of you. There's no better investing police to take charge of your portfolio. It's your job to make judgments, to decide on materials that you're going to use. And it's your job, if you'd like a copy of these slides, to send me an email and tell me, and I'll send you a full copy of the slides. If you have questions, it's your job to contact me, and I'll answer your question. And if you have suggestions for future bull sessions, it's your job to tell me what you'd like us to talk about, and we'll talk about it. Now, my email address is the one with my name in it. I think that's to your right on the bottom of the screen there. Were they hearing me at all? Not really well. Okay, now are they hearing me better? Well, we'll assume they are. Okay, if you'd like to ask Mark questions about manifest investing, because we're going to use it off and on during the day today, then that's Mark's email on the other side. Any old timers in here remember Mark's articles on the back page of the magazine? Mark Robertson, who was the writer, 2 or 3 of you in the room remember that he was a writer for about 15 years for Better Investing magazine. And then he struck out on his own with this website. We're crossing our fingers that those paths are going to reconverge in the next 5 or 6 months. We'll see. We're not certain about it, but we're hoping, okay? Better investing depends on a philosophy of patient discipline. And those are two words that every Better Investing member needs to internalize: patience and discipline. Because we're long-term fundamental investors. We play around. Mr. Nicholson, who founded Better Investing back in the 40s, suggested that once you knew what you were doing, that was an important clause in the front of the sentence, folks. Once you knew what you were doing, then you could take 10 or 15% of your portfolio and move into what he called non-traditional investing. I call it speculating. And that's okay to look at an initial public offering and say, that kind of excites me. I'm going to put a little bit of money into it. And that's okay to occasionally buy some bonds if you think bonds are particularly attractive. And that's even okay to put some money into cash if you think it might be time to raise a little cash in anticipation of spending that cash in the not too distant future. Some of my best investments were made in 2008. We'll talk about that later on. What's great about Better Investing, it tries to keep things very simple. And those of you that would like to become advanced investors by learning about every single number that's on a value line sheet, or deciding that you're going to follow the talking heads on TV when they go down a rabbit hole about technical investing, or when they're talking about how you can read the charts like tea leaves. If you want to do that, that's okay. But identify it for what it is. It's not fundamental long-term investing. Our goal is to sleep at night. Okay? And I found very early on in my investing career that I was going to have a very difficult time sleeping at night if all of my investments were things that I couldn't actually study in any way, shape, or form. So I discovered Better Investing along with my wife. We've been partners at this since the very beginning. We retired with the goal that we would do an activity that we could do together for the rest of our lives. And that's why she's with me today. She does all the backroom stuff for our chapter, and I do all the public stuff because I'm so pretty. All right? Look at that chart. What immediately strikes you? I hope it's the big blue squares. Okay? Do you even see, on first glance, the little tiny pink squares? Well, the pink squares are recessions. And the blue squares are bull markets. And that big blue graph line going across from the lower left to the upper right of the graph is the S&P index. And sure, it wiggles a little bit. And there's been times when you've probably been frightened out of your mind about what the S&P is doing if you've been investing for a number of years. But the stock market generally moves up. And it moves up at a rate of about 10% a year, and it's been doing that for over 100 years. Sometimes faster, sometimes slower. But the message this slide should give you is, why are we always worried about preparing for the pink squares when we're pretty confident that the blue squares exist and are going to continue to exist? Okay, there's a blue square after the Great Depression, folks, and there's a big blue square after 2008. What did Mr. Buffett think about 2008? Well, he says he hopes he lives long enough to see it happen again. And in a very twisted kind of way, so do I. Because while it's painful when it happens for a year, maybe even 18 months, some of the very best investments that I ever made happened in 2008. My biggest holding, our biggest holding, my wife and I, is Microsoft. And I first bought Microsoft at a ridiculous price in 2008. I belong to clubs that discovered that Mr. Trump gave us a wonderful opportunity to buy Microsoft last April. I didn't need any more in my portfolio, but I was in a couple clubs that that were loving Microsoft and could never find an opportunity to buy it. Well, boy, did you get one in April. Microsoft has recovered almost everything and then gone up 50% from that point in April. Adam Smith, this is not the Adam Smith from history, but Adam Smith is a well-known financial columnist writer. And he asks Warren Buffett, what would you do if you were going to enter the market today? Warren Buffett said, I'd do the same thing I did 40 years ago. I'd read everything I could about every stock in the market. Mr. Smith replied, there's 27,000 public companies. Buffett says, we'll start with the A's. You can get a really great list of newer companies. This is an old screen capture because you can buy an old Hoover's Emerging Companies book and you can buy it for less than $1. If you want the brand new one for 2025, it's going to cost you about $300. So my suggestion, buy a 2023 or a 2024, okay? By the time that you finish Hoover's, the 2025 will be on sale. Here's a chart that combines the methodology of AAII, that's the American Association of Individual Investors, with what Better Investing believes. I know it's kind of busy, but you see that red line going through the graph? The guy that founded AAII said, there should be a line of reasonable expectations on any portfolio. And he set that line at 10.5. What was he looking at? The stock market's average return over the last 100 or so years. And depending on the source you look at, it varies anywhere from 9 to 11. That's why we say 10. He said 10.5. I'm not going to argue with him. You see those green bars? Well, those green bars represent the value line arithmetic average, and those green bars are quarter by quarter by quarter. Sometimes the average is above the line of expected return, and sometimes it's below. You see the last bar is light green because it's a work in progress. And since we present this graph at every bull session, that bar won't turn dark green until the quarter ends at the end of September. Right now, it's just a work in progress. And as of last Tuesday, it was just a touch above the red line. That's a blow up right there above the graph, pointing to the light green bar just being just a small touch above the line. You see the orange dots? That's what the value line forecast suggests that the market might be doing. If you read a value line sheet off to the right, that screen capture should be very familiar. And as of last week, Value Line thought that in the next 3 to 5 years, stocks should advance about 40%. I'm going to amend that sentence that I just said. Stocks that are in the Value Line index should advance about 40%. The Value Line index includes all of the S&P companies and then a great sprinkling of medium-sized and small companies to complement those very large companies from the S&P 500. Value Line covers 1,200 stocks in its index, give or take a few. You see that blue line? Those blue dots, I'm sorry? This is what my par represents. And right now, I'm just going to say that's the Manifest Investing Potential Average Return for the Manifest Investing database. About 50. Old box off to the right there. Translates to 8.3%. With my apologies to the engineer Keith sitting right in front of me there. We don't really care too much about decimal points because we're doing everything with crayons. There's a wide tolerance in all of the numbers that we use to make forecasting. Any analyst worth their salt will tell you that. They're just guessing, and we're guessing. We hope that we're guessing based on good data, but we know that 20% of the time we're just as wrong can be. And we know that 20% of the time we're just as right could be because we just go much further than we thought we were going to go. But about 60% of the time, and this is proved in academic study after academic study after academic study, about 60% of the time we're right on with our studies. It's called the rule of 5 because 20% exceeding, 20% failing, and the other 20% add up to 100%, the rule of 5. Here's the round table. We were sailing for 2007 through 20,000, about 24 and a half. And then the market took off. And it's harder and harder to keep up with the market. In the last roundtable, that was the August roundtable about 2 weeks ago, we actually started to move upward again in our graph. You can see it at the tail end of the graph there. That orange line represents the better investing goal of beating the market by 5 percentage points. I know most of you have heard that it's 15%. It's not. It's beating the market by 5 points, which over time is 15%. By the way, think about it. If the market's doing 20, would you only want to do 15? Okay, that's why the goal changes as the market changes, okay? This goal, folks, that George Nicholson said back in the 40s is extremely aggressive. Beating the market by anything is not easy. We also have done some studies with some very unusual sources. Rex Tillinghast is a financial analyst, and he's a great source for probabilities. But we've been studying Annie Duke. Annie Duke is a poker player and a doctor of psychology, and she holds the psychiatrist degree. And she studies probability because she's also the United States poker champion the last 2 years. And then we also studied Peter Lynch, who talked about outperformance. And just to add one more name in there, we studied Roger Federer. Yeah, the tennis player. Okay. How many times do you have to succeed with a stock pick? Well, you know, you can have results that match Federer's results, or that match Lynch's results, or that match Annie Duke's results, which are fantastic, or Rex Tillinghast's results that are fantastic. And you can do it if you only win 55% of the time. Federer won over 80% of the matches he played, but he only won 54.8% of the points within those matches. You want to be a successful investor? Aim for a 55% outperformance. That means that 55% of the time you'd like your stock to beat the market. That's all. Whatever the stock is you pick. Not by 5 points, not by even 10 points or 20 points, just by a half a point or a quarter point or for that matter, match the market. How much can you lose when you invest $1,000? $1,000. How much can you gain? It's infinite. Okay? Talk later to the man and woman who invested in NVIDIA 14 years ago when none of you even knew the name of the stock. Now, that might be an exception. There might be a gamer in the room. Okay? Did you invest in that gaming stock? No. You didn't?
I did during the pandemic, and that's been great.
Absolutely. If you did it in the pandemic, you're still feeling good about yourself. My grandson was 12 years old 14 years ago, okay? And he's in our family club, and he went to his grandmother, who's a great stock picker, by the way. She won't talk about it very much, but she is. And together, the two of them brought NVIDIA to the family club. And the reason was he really liked the way those chips operated in the games he played. So we put a small amount of money in it. Our basis in NVIDIA is less than $1 a share. 55% of the time you need a winner, and you need 3 or 4 home runs during your career. Okay? And your career can be 35, 40, 45 years. But you do need 3 or 4 home runs. I'm going to count Microsoft, Google, and NVIDIA as my 3. And then I'll give you 3 or 4 others that we managed to stumble on, because stumble you do sometimes. And NVIDIA was a complete stumble. We never anticipated what it was going to do in the future. Here's the top 20 stocks. Folks, this is not the kind of portfolio I want you to put together in a club. This portfolio has over 200 different stocks in it. It's called a tracking portfolio, and it keeps track of every single thing we talk about at the round table. Okay? The top 20 holdings are staring at you right now. That very busy legend up in the upper right-hand corner there says 15X CTSH. That means that over the round table's history, we've chosen Cognizant 15 times. Cognizant Technologies. We've chosen Gentex, a Michigan auto supplier, 13 times. We've chosen Google 12 times. And by that point, you can get the idea of how the legend worked. There are a couple companies on the top 20 that aren't in the legend because we've only chosen them once, to our deep regret. Costco was only chosen once about 15 years ago. It never became affordable in the last 15 years as far as we're concerned. But that one cash infusion of $1,000 as of last Tuesday was worth $21,000. Great. Natalie and I don't own it. We wish we did, but we don't. Okay? We'll go over to the right side. I just want to draw your attention.
I didn't think about it.
At the round table, the MyPar number, that's the average expected return from the entire Manifest database, was 8.6%. Lower than that 10 that we say is the historical average. So that tells us the market is a little bit overheated. That number's gotten as low as 4 in the history of Manifest, and it's gotten as high as 32 in the history of Manifest. When would you like to be a buyer? The higher MyPar goes, the easier it is to find good, solid stocks at reasonable prices. It's a little bit hard right now to find good, solid stocks at reasonable prices. But folks, they exist. Okay, we're going to come back to these kind of things. But boy, would I love for you to internalize this slide and ask for copies of the slides and then take this one to your club. Since we began in 2010, and we're into our 16th year now, our rate of return in the round table has been 15.9%. That's long-term, and that's over that 15 goal. 232 of the 869 selections are losers. We show them to you, we point them out. 232, almost a quarter of them are losers. And they have terminal values right now of less than $1,000. We put in 1,000 for each of the companies we pick. The cumulative loss for all of our losers is almost $97,000. The gain from our best, the gain from our largest holding, that's Microsoft, and we've put $5,000 into Microsoft. The gain from just one of our winners, and there's a lot of them, is $126,000. What are we afraid of as investors? Why, when the pandemic comes, and I belong to 2 clubs that did this, would you raise all kind of cash and then sit on it for 2 years? Okay, why would you do that? It's fear that drives that kind of behavior, and we're trying to tell you, don't panic. Again, 650 funds with an average appreciation of 5 to 7%. And the market performing at 10. Do you understand why Better Investing is particularly eager to keep you away from maybe some of the mutual funds and ETFs that exist? The average mutual fund and or ETF, and he follows 650 of them, the average one returns 5 to 7%. The market as a whole, we would much rather see you invest in the S&P 500 index, which returns the market average, which over time is around 10%. It's not beating the market because it's what the market is compared to many times, but it's at least matching the market. Most Better investing clubs that I visit are able to at least match the market. Many of them beat the market by 1, 2, or 3 points, and a significant group of them, as much as a quarter, beat the market by 5 or better. I have visited clubs and I've monitored their books. I understand the way the accounting works. And I have visited clubs that are beating the market over long-term periods of 8, 9, 10%. I will throw out a number for one of the clubs I belong to. It's my family club. And I will tell you that it's beating the market over the last 27 years. It's beating the market by 9 points right now. A lot of that due to a single stock, NVIDIA. Don't panic. Redefine your definition of risk, because it's not volatility. Risk is not volatility. Risk is managers that don't know how to manage money. Risk is companies that do illegal things. Risk is companies that just change their CEO without telling anybody. That's risk. Volatility is opportunity. That's what makes a market. And that's what makes better investors that are looking for great stocks at reasonable prices. It's what makes us good investors. We refuse to buy Costco when it's overpriced. Costco has a PE right now in the 50s. It's a great company, but it's not that great. Okay? We are not the investors buying from Rodeo Drive with hugely inflated prices. I hope I don't offend anybody in the room, but my wife does not own a Kate Spade or Michael Kors handbag. Volatility is not an appropriate measure of risk for the long-term investor. Volatility is our friend, and we need to recognize that. And we need to stay roughly fully invested. There's nothing wrong with keeping 4 or 5% of your portfolio in cash. There's probably something wrong with keeping 25 or 30% of your portfolio in cash. This is not Better Investing's graph. This is not Manifest Investing's graph. This is an independent graph. And this shows the odds of gaining in the market depending on your holding period. Look what the odds go up to of having a gain in your portfolio if you hold for 20 years. Don't panic. We are not buy and forget investors. We sell when it's appropriate. I'll even give you all the rules for selling in a little bit. I know that sounds like a 7-hour class. It's about a 6-minute explanation. If you bought Home Depot 30 years ago, like our friend Cy Lynch did, Cy is the former chairman of the big board, the NAIC Better Investing Board. He's an Atlanta volunteer, and he's one of the Knights of the Round Table for the Mid-Michigan chapter. He bought Home Depot 30 years ago at $11 a share. And that one share that he bought at $11 is now worth $704, that single share. So if he bought 1,000 shares, and he bought more than that, think what Cy's feeling right now. Susie Artsberger, she's our director of IT for the big organization, the entire organization, okay? She and her husband eloped, took the wedding money and bought 3 shares of Berkshire Hathaway. 11 years after they eloped, their $6,910 investment was worth $73,900, and they bought a house. They bought a house in Bloomfield Hills. Does anybody know that suburb? You're all from the South, so you probably don't know that suburb, but it's sort of like Beverly Hills out in California, or what's your swankiest suburb around here? No swanky suburbs are on High Top, right? Okay. Then dream of the swankiest suburb in Charlotte. There has to be one in Charlotte, and Bloomfield Hills is that. Bloomfield Hills is where all the auto executives live, and they get paid a lot more than the union members get paid. I didn't say that. Here's Mark Robertson at a much younger age on the left there. That's his parents. His parents went to an investors fair that my chapter put on back in, I don't have the date here, 1982. Biomet, an Indiana company, was a presenter. And if you had invested $2,000 in Biomet, and that was a reasonable investment number to make in 1982, if you had put $2,000 into Biomet in 1982, in the 1990s, before the company was bought, your stock would have been worth over $1 million. There's just all kinds of investments that you can make. Mark and I run a simulation called the Tin Cup. And this simulates a young person putting in the maximum match for a 401k or whatever else they can put money into. Today you have a little bit more choice than just 401k. And we've been putting that maximum match in since 2004, into this portfolio of stocks that we manage. That blue line, there's that line of reasonable expectations again. Notice how the portfolio has risen above the line and gone below the line and above. Right now it's a touch below, but we're not panicking. We know this is going to go above that line, or at least come close to matching that line. Do any of you really even see the Great Recession of 2008 on this graph? As time goes by and you change the scale of the graph to reflect what's happening, things that you thought were wrenching, gut-wrenching, life-changing kind of become blips on the screen for you to not worry about so much. Mr. Schloss, Walter Schloss, who was a money manager from the mid-50s to the mid-90s and was a great proponent and booster of better investing during that time, basically invested in a little room about a quarter the size of this room by reading Value Line. That was his source back then. We didn't have computers for most of that time. He returned to his investors over the life of his career an average of 18%. That's a really nice return. And the purpose of this slide is to show you how drastically money amounts change as you move up the ladder just 1% or 2%. All of the numbers reflect an initial investment of $100. And I think if you put $100 in and then waited during his career just short of 40 years, and if you had 11,000 for every 100 you put in, I think you'd be happy. But wouldn't you be happier if you, instead of 11,000, which means that he got 13% of you, wouldn't you be happier if he had gotten 15%? I mean, 11,000 to 23,000? That's just 2% better. So you're telling me that just 1 or 2% better can do dramatic things? And I'm showing you these 3 simple indexes. We do not recommend index investing. We're buying companies. But if index investing is what you do, the blue line is where you are with $100 in the past 20 years for the S&P index. $100 has become $752. Okay, you're pleased. Your money grew. That's good. But if you would have done the VUG, that's the Vanguard Growth Fund, and it's only giving you a couple more percent than the S&P is, your money would have been $1079. But if you went to the triple Qs, that's matching the NASDAQ, and it's only doing a couple percent more than the Vanguard Growth, then your return would have been $16.94. A couple of percent makes a difference. Remember what I started out by talking about, the forest and the trees? The forest is the percentage that your portfolio is going to return over time. We're not talking about the individual stocks in your portfolio. We want to talk about your portfolio. Here's some perspectives on different investments for the last 10 years with a couple of exceptions. You'll see 10 stocks on this list, 10 individual stocks. And 6 of the 10 are beating every single index that we can think of that's well known. It's beating the Tin Cup. It's beating the Round Table. Visa is doing a good job at beating the indexes, and so is Home Depot. And only 2 of the 10 are losing right now to the indexes. That last column is not total return. That's relative return. Total return is 3 columns in. Relative return is how much did you beat a selected index. And our selected index is the Wilshire 5000. Oddly enough, it covers about 5,000 stocks. We're just trying to make the case that the 10 most widely held stocks by Manifest Investing subscribers, and that's the 10 that are on this list, are really doing a wonderful job of beating the index when you put all 10 together. If you just focus on CVS Health, then we're not doing real well. But we would ask you to focus on all 10 of them as a group. That's a portfolio, and that's what you should be watching. This is so true. And this was said to me by somebody in the very first Better Investing class that I ever taught back in, I don't know, the last century. You can't celebrate something you bought 20 years ago, 20 years from now, unless you get out there and discover a promising opportunity today. Okay? You can't tell war stories, folks, if you just hold cash. Because cash isn't going to beat anything, probably not even inflation. This is a lot of words, and basically what I'm saying is George Nicholson wanted us to look at portfolios. Stocks were important to put into portfolios, and you had to know how to select them. But he wanted us to keep an eye on portfolios. How many of you belong to a club where you still believe that every stock in your portfolio has to return 15% or better? Oh, then somebody in the room is lying to me. Because there are clubs that believe that, okay? And they believe it with a fervor because they've misread the investor's manual. Okay, the investor's manual never says look for a stock that returns 15 or better. It says look for a stock that's selling at a reasonable price and put it into a portfolio that performs at 15 or better. Well, that means, folks, that you can have stocks that perform at 9, as long as you have 1 or 2 that perform at 18 or 19. Okay? You can have lots of different performance numbers as long as the portfolio performs where you'd like it to be. George Nicholson was talking in the 40s, and things have changed since the 40s. I was born in the 40s, and things have changed since I was born. I look in the mirror, I recognize that right away. George Nicholson used a slide rule. He had access to the best stock information because he was a stockbroker, but he didn't even have a calculator. I bought my first calculator when I was teaching in 1976, and I paid almost $140 for a calculator that did what this $9.99 one does today. We need to amend some things that Nicholson talked about. Nicholson would never have dreamed of companies like Microsoft, Facebook, Meta, Alphabet, Google, Tesla, Amazon. He would never have dreamed of these huge meta companies, mega-sized companies. But they exist today, and they're growing faster than he ever anticipated that a huge company could grow. So a lot of the rules have to be slightly amended, and we're going to do some amending. Your model club, who's in the model club in here? Oh, we got a good representation of the model club. Great. Your model club contact, Mr. Jordan back there, told me that you have he was making amends to me. He was apologizing in advance for what I was going to say about your portfolio. And he said, you don't have any, he says, we don't have any small stocks. And I don't talk about small, medium, and large stocks. I talk about faster growing stocks and slower growing stocks. And that's the exact vocabulary that Nicholson used. I'm going to the Better Investing website, and you can do this on your own. And I'm clicking on that spyglass right there. Do you see it?
Yep.
That's taking me to the stock screener in Better Investing. How many of you have been to the stock screener in the last month? Then this is an out of the ordinary audience, because usually in an audience of 40 or 50, I'm lucky to get a single hand. All right. The stock screener has 3 pieces to it. I'm going to whiz through it pretty quickly because I'm trying to make up a little bit of time. But the first part has a set of criteria that you can pick from. And since I'm always looking for faster growing companies, why, they ask? Because in time, faster growing companies are going to become slower growing companies. And I want to hold them for a long time. So I'm always looking for faster growing companies as new ideas to add. I'm going to ask for sales growth greater than 12% and earnings growth greater than 12%. And I'm going to stick to the US exchanges. And I'm going to be kind of picky as far as the Morningstar numbers are concerned. I'm going to ask for A in financial health and for B grades in profit and growth. Okay, that's a pretty good screen. And I get 18 companies out of the almost 8,000 companies in the database. This is a pretty tight screen. So now what I do is I click next to the first one on the list, even though I know all about it. I own Alphabet, a lot of it. I click that little icon right next to the Alphabet name, and up comes this thumbnail. And you know what I'm looking for, folks? This chant began in mid-Michigan, and the chant is up, straight, and parallel. Okay? I'm looking for a sales line that moves from the bottom left to the upper right. I'm looking for it to be roughly parallel with the earnings line, which is doing the same thing. And I want them to be as straight as possible. The straighter the line, the more consistency exists in the sales or the earnings. You see that little icon that I've circled up there on Google? If I hit that icon, I can now go to the second company on the list, which is Alphabet with a different ticker. And then that icon will be on that one, and I can hit it and go to the third company on the list, which is Chipotle Mexican Grill. And I can go all the way through these 18 companies, and I can do old school, a yellow pad and a pencil. And I can jot down the interesting ideas from this list of 18, and I can do it in a minute or two. All I'm looking for is up, straight, and parallel. There's also predefined screens in the middle. I love the small company screen, so I've greened it out. That's the one I'm showing you. When I did this about a week ago, it had 15 entries out of over 8,000 companies. It's a really tight screen. And this one is focusing on companies with very small amounts of sales. It still has very fast growing sales, very fast growing earnings, but it's focusing on companies that maybe sell something less than $1 billion in a fiscal year. Okay? I look at this screen once every 3 or 4 weeks, And if you do it on a regular basis, then you notice who stays on the screen, but more importantly, you notice who's new to the screen. And that's what interests me, is what's new to the screen. Okay? Again, if you choose that little icon next to the first company and click it, then you'll go to a thumbnail, those lines, and then you can click through every single company on the 15 company list, and you can write your ideas down. Screeners are just for ideas. They're not to make buy, hold, sell recommendations on. They're just for ideas. Some of you are very visual. When I teach a class of students, about a quarter of you are visual learners. So those screeners don't work real well for you, but this does. When you get to this part on the screener and you click anywhere on it, a bigger picture comes up. And when I tell you that the darker green the company is on this picture, the more favorably it's been viewed by the better investing community that uses our tools. So the darker green ones are interesting companies for me to explore. So are a shade lighter than darker green. None of the bad companies are on this list, but the orange and red colors indicate that they're probably not affordable. All right? So this heat map is directing you towards companies that our community feels might be affordable. The bigger the square, the more people have done SSGs on that company, and it's reflected in the size of the square. Okay, look how big Microsoft's square is. And this was only less than a week ago. I don't think Microsoft's a buy today. It's a yellow block, but it's a really big square. NVIDIA is kind of chartreuse color up there in the upper left-hand corner of the picture. But I don't think NVIDIA is a buy right now either. But this chart gets updated every night based on price changes. And when President Trump next goes on TV and announces another set of tariffs, and the market does something weird, you might want to look at the heat map and see where there's opportunity. Okay? Manifest Investing has a great stock screener, and I'm going to stop here, and we're going to take just a 10-minute break, and then we're going to try to come back so I can finish my material, talk about your portfolios, and still leave 10 or 15 minutes for some questions. This is Manifest Investing's home screen. Manifestinvesting.com is a website. You can go to the website. You can get a trial period for 3 months, absolutely free. All he takes is your email address. That's all he takes. And then if you give him a call after 3 months and say, I just loved your site, he gives people a discount all the time. I think it's $80 a year, but if you can't get it for 60 or less, then you're doing something wrong, okay? Up on top, I've circled stock screen because he has a wonderful stock screener. And it can be used at all different kinds of levels. It has about 40 different criteria on the list that you can choose from. But I'm going to make this bigger and show you a wonderful stock screen that I do regularly. And I'm only asking for a par value. How many of you do SSGs? Okay, this side of the room does, this side of the room doesn't. All right, par is the value that you have using your average PE value. It's potential average return. Mark's par calculation is exactly the same way the SSG does it, okay? So I'm asking the database for a par value of 12. And I can do that because this database does an SSG on every one of the almost 7,000 stocks every night after the market closes. Now, it does it electronically. He's not sitting there, till 3 a.m, but it does an SSG every night. So you have a fresh SSG at the open of the market the next day. And it includes a return value. Better investing tools do not give you a return value. Mark was a great student of George Nicholson. He worked for Better Investing for many, many years, and he developed a quality rating based on Nicholson's work. I don't have time to get into the 4 pillars that it's based on, but suffice it to say that it's a percentile, and we like to stay in stocks in the top quintile. That means 80 percentile or above. We will occasionally move down to as low as 60, but most of us, most of the time, will not say we're investing if we're looking at a stock with a quality less than 60. We will label it speculation, not investing. And we'll keep that to 10 to 15% of our portfolio. Investing, we love 80 or above. We'll occasionally move down to 60. I've said, look for stocks with a par, a potential return of 12. That's 2 above the market average. Look for a quality of 80. And then look for financial strength of 80. He develops a financial strength quintile or percentile the same way that Value Line does. So we're saying, look for the best stocks based on financial strength. And then, and here's the 4th one, and it's the most important with this forest trees argument, look for sales growth of 12% or better. Earnings follow sales. Stock price follows earnings. Once again, earnings follow sales. Stock price follows earnings. Companies that don't have any earnings are priced on a price to hope ratio. Companies need earnings to have a PE ratio, which we absolutely believe in. We're not real strong proponents of price to hope. 4 fields, and it gave me 16 ideas. Nintendo. I haven't looked at Nintendo in years, but Manifest is telling me it has a really high quality. It has a par value close to 20%. Its financial strength is 83% percentile. And on top of that, if you're an income investor, it pays a better than average dividend. An average dividend in today's market is less than 2. This pays 2.5%. This is certainly a company that I might take a second look at. Look at its sales growth. Typical sales growth, folks, is somewhere in the low teens to mid-teens for these kind of companies. The analyst community, and that's what this data is based on, the analyst community feels this company is going to grow in excess of 40%, and that's a 5-year call. Now, you know what they make, Nintendo, right? Gaming systems and games, okay? Look at the second one on that list. Now, I don't want you to run out and buy it because I named it before in the discussion, but there's our United Therapeutics again. With a 40% gain in price last week, it still carries a PE of around 17. This is a list of companies that's exciting, but it's not necessarily a buy list. We urge all of the members in all the clubs I belong to, and we require in 4 of the 5 clubs, we require them to do SSGs and to have SSGs that validate the manifest scores, that come up with the same general analysis as the manifest. And then we would like them to be validated by Value Line and Morningstar if the studies exist in Value Line and Morningstar. We'd like to have as much validation as possible for our screening ideas. Here I am using the screener, and I'm going to fill in one field. Mark set something called the manifest rank, and that's a combination of par, return, and quality. So these are the highest quality companies with the best par. Okay, and he calls it the ivory soap screen, because we fill in the number 99 and 44/100%. Who's old enough to know that reference? Oh, a lot of folks aren't, okay? I keep telling him it's way too old a reference. Ivory soap used to have TV commercials, and they would say ivory floats because it's 99 and 44/100% pure, okay? So we fill in 99.44, and we got 16 more ideas. This one started out with a very interesting company. I'm going to skip the first one, but Cactus is an extremely interesting small company. One of our friends from the Rocky Mountain chapter runs a program called Small Talk. And all they talk about is small stocks. Her name is Betsy Wills. And Betsy's been on our roundtable and she's at our bull sessions. And she just brought Cactus to our bull session a week and a half ago. This is a small Schlumberger. Think of it that way, okay? Do your own research. Notice Cactus is followed immediately by Schlumberger. It's now called SLB. They don't call it Schlumberger anymore, but Mark has kept the old name. There's a lot of great stocks on this list, and there's overlap between this list and the one we just saw, okay? Morningstar can be a wonderful source for ideas, not their screener, okay? Not their screener. But they study mutual funds. That was their original business. Morningstar originally only studied mutual funds, okay? So when you look at those 20 mutual fund names that I gave you earlier in the presentation, 20 outperforming funds, you can find out the stocks that are in those funds. How? Well, call up the mutual fund by ticker. All mutual funds and all ETFs have tickers. And I'm calling up that one that was at the top of the list, the nuclear one that Natalie and I own. Its ticker is NUKZ, N-U-K-Z. And I've circled right at the underneath the name of the fund, I've circled where it says holdings. Do you see that? If you press there, then you get a list of the holdings in the fund. Now, mutual funds do not have to report holdings more than quarterly. So the list might be a little bit old, but look, in the columns that list the holdings, you can find out when it was first bought in the mutual fund. I'm extremely interested in things they just bought. Okay, so you can look at that. You'll notice in that bottom left-hand corner where I've circled how many pages there are to the holdings, there are 5 pages and 44 total holdings. Okay? And it's a coincidence that the top 10 holdings, this is the top circle in the middle, the top 10 holdings occupy 44% of the portfolio. That 44 is just a coincidence between that and the totals that they're showing you in the screening here. Okay? I'm getting companies I've never heard of before, in addition to companies that I know about. And companies that I've never heard of before could be great ideas for future investment. Okay, here's the when to sell class, because Rick asked me to do a when to sell portion. Here it is. The original investor's manual and all of the investor's manual through the 90s, and we no longer print them, so that's the last one. Those manuals all say that there's only 2 rules about selling. And rule number 1 is you sell a stock to make the portfolio better. It couldn't be simpler. It doesn't talk about whether you like it or not. It doesn't talk about the par value. It doesn't talk about the PE value. It doesn't talk about any of the troubles the company might have or any of the great story that might be sitting behind that stock. You sell to make the portfolio better. And your aim in portfolio is par. You want to continually keep your eye on the potential return of the portfolio. Also, remember, one of our 4 cardinal principles is to buy high-quality growth companies at reasonable prices. That means you might be selling a high-quality growth company at an unreasonable price. Stocks sometimes get ahead of themselves. The Mid-Michigan Model Club wept big crocodile tears the night that we finally sold our Costco. But we sold it, well, not all of it, but we sold some of it because number 1, it was too big a piece of our portfolio. And number 2, its par value had dropped to around 5%. We kept some of it because the par might renew itself, but we want to follow our par for the portfolio. The Mid-Michigan Model Club made a huge mistake at the pandemic. They sold stocks and sat on the cash for 2 years. I've said that once already today. That's a huge mistake, to sit on cash for a long period of time. When they finally realized what they were doing to the par value of the portfolio, because cash was returning at that point about 0%, when they finally realized that what they were doing, we began to go back to our principles of watching par. And I'm happy to report that for the last 2 years, the Mid-Michigan Model Club has beaten the market by more than 12 points. Okay? But it took a lot of very difficult decisions in the portfolio that we had left because we didn't save the right stocks. We saved the stocks that we liked, or we saved the stocks that had huge capital gains because we were afraid to take capital gains. When they first told me back in the 90s to rejoice when I pay capital gains, I thought they were crazy. But folks, rejoice if you have to pay capital gains. That means you're making money. You don't pay capital gains when stocks lose. We looked at the roundtable portfolio. Remember, that's a tracking portfolio with hundreds and hundreds of stocks in it. And we said, do we have companies that par values are sub 5%? And we found this list. Now, notice, it's not that many companies, but it's the lots within the companies that are giving us this thing. We have 3 lots of Fastenal, for example. Okay, and each lot has a par of 1.6%. Okay, so we would sell all 3 lots, but they go into the portfolio as 3 separate holdings because they were bought at 3 separate times. We asked the roundtable portfolio, did we have any stocks with low quality? We did not buy them with low quality, except for Liberty Latin America, which always has been there. That was a guest that made that pick. We bought most of these stocks when their quality was up above 60 at least, and mostly above 75 or 80. But quality changes over time. And here's where some of these stocks are right now. One of them was a stock that 10 years ago was never not in a mid-Michigan portfolio in every one of our 120, 140 clubs. It was Dow Chemical out of Midland, Michigan. But Dow Chemical has gone on some tough times. We asked the roundtable, looking at sales growth, are there any companies that are growing their sales in beneath 5%? And we found a long list of those. Earnings follow sales, and stock price follows earnings. How can you expect to grow stock price at 15% when earnings are growing at 6 or 7 and when sales are growing at 4 or 5? Here's the Mid-Michigan Model Club. I'm so proud of these people in the last couple of years, and I was ready to quit this club 4 years ago because they wouldn't listen. But they're listening now, and I'm just really pleased with them. This is their current portfolio, and this is the way it looks in our stock study guide, in our SSG Plus tool. This is the report called the summary report. And the only thing wrong with managing the portfolio from the summary report is it doesn't tell us enough information to make those kind of decisions that we need to make. We discovered about a dozen years ago that if we would also look at a dashboard, and this is the second time you've seen a dashboard now, you can get information that's not included on the SSG Plus, and it's going to help you manage the portfolio. Now, the SSG Plus gives you great sector graphs, so does Manifest. But notice the difference between the size graphs in Manifest and in SSG Plus. The Manifest size graph is based on sales growth forecasts. Faster growing, more than 12%. Slower growing, less than 7%. Mid-size growing, 7 to 12%. Does that sound familiar to the size things we talked about in Better Investing? It certainly does, because it comes from the same source, George Nicholson. Same numbers. And they've held, the percentage numbers have held since 1944. The size of sales numbers have to be updated every 3 or 4 or 5 years, depending on how bad inflation is. They're out of whack right now. When we say a small company is 1 billion or less, we really should be saying a small company is 3 billion in sales or less. Amen. Okay? They're just out of whack right now. But, and I won't finish any of those buts because it gets me into trouble every time I go there. We'll just say that Manifest right now is giving us a better guide to keep our portfolios at that 15% goal. Okay? Here's how we use those dashboards. First of all, every dashboard gives us a report card. And here's the report card for this dashboard you just saw. We've talked about my par twice now. Here's the third time through. And this is a really recent screen capture from Monday. Okay? My par was down to 8.2% on Monday after the market closed. Our goal is to beat the market by 5 points. And if the average of the market is 8.2, then our goal is at least 13.2. That's only 8 plus 5. That's all it is. And Nicholson, in other writings, said, if you're trying to beat the market by 10 points or more, it's a fool's errand. It can be done occasionally, but it cannot be done consistently over long periods of time. We think he's probably pretty accurate as far as most clubs are concerned. So we capped our sweet spot at 10 better than the average, 18.2. And we'll occasionally look into the 19s or 20s when my par is here. But if my par is 36, then that's just probably too good to be true. That's all. The analyst community has gotten way over their skis. Okay? The other numbers represent the actual numbers in the portfolio. This portfolio has a potential of 8.6% par. That's a little over the 8.2 average, but it's not a par we're happy with. I will tell you, when the market's doing 20, 25, 30 like it's been doing off and on in the last 2 years, you're running a race where you're just panting to try to keep up with the average a lot of times, because your stocks that you bought that had a potential of 15, 16 have used up a lot of that potential because the price has gone up. It's a great problem to have, but it keeps you on your toes in managing the portfolio. Our quality is 92.7. That's a weighted average of the stocks in the portfolio. So the biggest holding in this portfolio, it's Google. The biggest holding gets the highest percent. The second biggest holding gets the second higher percent, and they're on. The growth, that's the most important number in the report card. It's just like your mom and dad looking at your report card and focusing, I hope, on the math score, on the math grade. All right? Earnings follow sales, and stock price follows earnings. And everything comes from sales. And folks, if the average anticipated weighted average for sales in your portfolio is 5, then you've really limited the par value in your portfolio, and you've limited what you can do as far as that 15% goal is concerned. Nicholson said you needed a number around 12, and we're at 12.2. We're good with George. The problem is George was giving us rules when the market was giving us dividends of 5%, because that's how you were going to fill in the difference between the 12 and the 15. You were going to fill it in with dividend and with PE expansion. You know, people discovering your stock and expanding the PE and really driving the price up faster than you anticipated. Okay? With dividends averaging less than 2%, this sales number now should be 13 or even 13.5. And that's what we're aiming at for sales growth. Okay? That's where we're aiming. If you're not aiming that high, then maybe you don't want to keep telling yourself you're failing every time you don't hit 15. Remember I said how aggressive that goal was? It is. It's extremely aggressive. It's okay for you. I'll give you permission. Okay? I'll even make a certificate. You can hang it on the wall if you want. It's okay to beat the market by only a point. Celebrate that if you do. Because I told you the average mutual fund lags the market by 2, 3, 4 points. Okay? If you can beat the market by even 1 point, you're doing better than the S&P index fund. So keep it up. And just push to try to make it 1.5 a year later, or maybe 1 3/4 even if you can. Sweet spot is aspirational, it's aggressive, and if it happens, that's great. Notice right now our par is just barely beating my par, and when we meet in about a month, we will be looking for ways to increase that par. How do you increase par? You buy stocks with higher par and you sell stocks with lower par. It's not rocket science. We're focused on sales. We would love it to be at 13 or more if we possibly could, and that's where we're aiming. How do you increase your sales growth? You buy stocks that have the potential to grow faster than what's ours, 12, and you sell stocks that are growing slower than 12. Now, you don't run in and draw blood in your portfolio. Everything that I'm talking about that might need changing should be done slowly and methodically. You should have reasons for every single action that you take. And if you can't come up with a good reason, then don't do it. Continue to think. We like to see high financial strength and high stability in the portfolios that I'm involved with. And a 78 financial strength is a very good number, and an 83 EPS stability is a very good number as well. EPS stability, think of it as how straight is the blue line on an SSG. A perfectly straight line has 100% EPS stability. A slightly wavy one might have a 96 or a 92. And if it has an 83, it's a little bit wavy, but not enough to be concerned. Yes, sir.
Is that coming from the R-squared?
No. R-squared can, I'm a math major. I'm going to talk to you about statistics. R-squared can fool the pants off of you all the time. So just be very careful of R-squared, okay? What are we going to do at the next meeting? Well, the report card tells us what we're going to do. We're going to get our business out of the way real quickly. We're going to hear stock reports from only 3 stocks. We're not going to go through the entire portfolio every meeting, okay? We're going to hear 3 or 4 minute reports on 3 stocks, only 3. And then we're going to spend the rest of the meeting managing the portfolio. We're going to play like in a sandbox. We're going to say a lot of what if, and then talk. Nobody's going to make any motions. We're going to just discuss and play. And we have a tool in Manifest that I don't have time to show you, but we have a worksheet tool that allows us to play and then erase all the play, go back to the beginning and play in a different way. And the play is always, well, what if we sold this and then did this? Okay? It could be simple, sell 1, buy 1. It could be more complicated, sell 2, buy 4. And we're almost always buying and selling from within our own portfolio. We're watching things like size of a holding. We don't want one holding to be like the family club that I manage, where NVIDIA represents over 50% of the portfolio because all of my relatives don't want to take capital gains. It's a personal thing, right? Yes, sir.
Letting your winners run.
There's value to letting your winners run to a point, okay? But you have to keep track of how your winners are running, all right? If your winners have done well for you in the last 10 years, but they've aged to the point where they're now running at half the speed of everything else. You have to retire them from your portfolio.
Hey, that's PepsiCo in our case.
There you go. PepsiCo is a wonderful example of something needs to be retired. Okay?
Boy, we love the dividend.
Look at this worksheet again. I know it's hard to read because it's small up there, but I'm going to talk it through, so just listen if you can't read it. When we meet, they're going to look at this dashboard, and they're going to say, Monster Beverage and O'Reilly Automotive are automatically on the hot seat because of their sales growth. Well, I'm looking at Monster Beverage, and I'm going to find it right down here. And its sales growth is only 7.4%. Now, the total potential growth is 12 for the portfolio, but Monster's only given us 7.4, and we'd like to be 13. Do you see why Monster's on the hot seat? Okay, and O'Reilly Automotive is right here, and its sales growth is only 7.3% anticipated. Now, those are good, solid sales growth numbers for large companies. And these are both large companies. But maybe we're going to have to do some trimming in the portfolio and put that money into something that has bigger sales growth numbers. I'm the portfolio manager, so I'm sitting there with a computer and a screen, and they say, will you sort that dashboard by growth? So I go up to growth and click growth, and it sorts by growth. And they can suddenly see the slow growers, but they can also see the faster growers. Okay? Will you sort that dashboard by value? They can see our smallest holdings in the portfolio and also our largest holdings in the portfolio. And we'll play like that for as much as 45 or 50 minutes at a meeting. And our meetings never, ever go past an hour and a half, and usually are about an hour 15. Okay? We also have MedPace, IE Systems. This is an AI play. O'Reilly Automotive, IradaMed, which I've talked about, Visa and Monster, and they're on the hot seat. Also, because of their par values. Their par values are low. But look at, immediately we put them on the hot seat because of low par, and then we take them off the hot seat because of their sales growth. They're just a little bit overvalued right now, and they'll correct. We're not going to panic if we come in and find IradaMed sunk 12% last month, because it's a little bit overvalued right now. Every stock will correct. And they'll do it within a 12-month period most of the time. We'll play this game until we're confident we've made a decision that doesn't mess up this report card. If anything, if we could improve the par, or if we could improve the sales, that's great. But our decision has to at least not mess up anything that's there, because we're pretty pleased with what's there. This is a really busy slide, and it's here for people that ask for the slides. These are additional, not rules, but these are additional things that we talk about in our portfolio management, okay? I'm going to go over just a few of them. 16 plus or minus 4 is a great number for any portfolio. But if your club is fewer than 10, you might want to veer towards maybe as few as 10 stocks in your portfolio. You don't want more stocks than you can handle. And in most clubs, 1 stock per person, maybe 2 for the really, really involved members is all they can handle. You don't want a stock to become an orphan because their stock watcher is a non-participant. All right? 100% divided by how many stocks you have tells you an average holding. And an average holding times 2 tells you when you should be concerned about one stock becoming too big. So let's do the arithmetic. I have a 20 stock portfolio. My average holding would then be 5. 100 divided by 20. Have I lost anybody in the room yet? Good. 5 is an average holding. When one of my holdings gets to 10% of the portfolio, I should start to worry about it becoming too large in the portfolio. It's not a bad company. In fact, most of the time, it's a company doing really well at some point. Okay? Okay? When it becomes 3 times an average holding, that's time to do some pruning. Any gardeners in the room?
Not good, but I can do that.
Do you ever prune your bushes? Why?
Because they'll grow all over.
They grow all over the place and they become really ugly, right? Same's true of stocks, folks. If you let them grow all over the place, they create ugly problems for you, and you want to prune them at a certain point, okay? You don't have to prune them back to 5%. Prune them back to 10%, okay? Sometimes they need digging out and throwing away. I mean, you've had bushes. We just did the whole front of our house. We dug out every single bush that we planted 37 years ago, yeah, and dug them all out and threw them away and put new bushes in because we had over the years let them become too big for the house. Same thing's true in a portfolio, okay? Faster growing stocks, 12% or better in growth, should be at least a quarter. And Mark and I believe they should be as much as 40 or 45% of your portfolio. Mid-size growers, 7 to 12, should be the rest. And you should have a really good reason for holding a stock that's growing slower than 7%. I'll give you a good reason. The Street Smarts in Saginaw, Michigan own 1 share of Berkshire Hathaway. And it's way too small for the portfolio, and it grows not at 7%. Why do they hold it? Because they send members to the Berkshire annual meeting every year, and to get into the meeting, you got to be a shareholder. It's a good reason. You do not need a stock from every sector. There's 11 or 12 sectors, depending on which system you use. And you do not need a stock from every sector. 5 or 6 sectors gives you sufficient diversity. When Better Invested told you to reinvest your dividends, they never meant in the company that gave them to you. Never. They meant reinvest your dividends in your portfolio. Okay? Not every stock in the portfolio should return 15 in order to get a portfolio return of 15. Now we have, we have 35 minutes. We're going to look at some of your portfolios now, and then I hope we're going to have some time for questions, okay? I'm now off of the slideshow, and I might need somebody to help me with this wonderful thing called Zoom. But I'm going to go now to Manifest Investing. Are you still seeing Manifest in Zoom now? Am I still sharing? Oh, great. Terrific. Okay. And I'm going to go to Dashboards, and I'm going to show you what came up. If you were new to Manifest, all you'd have come up was My Dashboards and New Dashboard. That's all that would come up. Okay. But I belong to lots of investment clubs, and 3 of the clubs that I belong to pay Manifest for their own space. So the B.I. Baker Model Club, the Mid-Michigan Model Club, and the Wolves. I can tell you a story about that name, but later, after we finish. Those three clubs pay, and the only way that you pay is Mark gives you a rate, and all the members agree to be manifest investors, and then he gives you a rate. The Mid-Michigan Model Club is big enough that we get manifest for $20 a year per member if all of our members sign up. So that's worth it to us for our own space, okay? So I'm going to go to SE Michigan. That's the other chapter that I use to just store stuff that I don't want to muddle up in my own clubs. And I'm going to look for the North Carolina Model Investment Club. There it is, right there. And I'm going to pull up the North Carolina Model Investment Club dashboard, okay? And we're going to start this will not let me make my screen bigger. I'm sorry. We're going to start by looking at your report card over here. And I'm going to talk to you about the numbers if you can't read them. Remember, my par, and this is today's my par, based on the end of trading yesterday. So it's gone down again. So the market's been, in the last week and a half, the market's gone from an 8.4% my par, which I showed you on some slides, to an 8.2, which I showed you on more recent slides, down to an 8.1 in real time. Okay? The market is a little bit overvalued. We had some great days this week in the market. I don't know how Friday turned out because I was on my way down to see you folks. If it was bad, don't tell me, all right? All right? Here's our sweet spot. 5 to 10 points above. That's our goal. That's our very aggressive goal. But we'd like to be at least at 8.1. And you know, the North Carolina Model Club is doing better than the Mid-Michigan Model Club right now. Your anticipated return, weighted average, is 8.8. Not great, but you're beating the market by 0.7 of a point. And that should be celebrated because you're going to see that that's a very difficult goal to hit. You're going to understand as you begin to focus on it how aggressive the goal is. But I'm asking you to start to study the forest rather than the trees. Now, you still got to know which trees are best to put in the forest, but you got to study the whole group together as a group rather than all these individual things, okay? Your quality, I very rarely see better investing clubs with a quality under 80. And your quality is 92.5. You know good trees. All right? No doubt about it. Okay? Your sales growth is better than Mid-Michigan. Ours was 12. Yours is 12.2. And that's a very difficult sales growth to maintain. But we're asking you to keep an eye on it, and if at all possible, push it up into the 13s if you can. Your PE ratio is 25.8, a little tiny bit on the high side. If we would have looked at the PE ratio of the Mid-Michigan, we would have seen it in the low 20s. I would get very worried if that moves up into the 27, 28, 29 range. That means you're beginning to take chances that you really don't need to take. Okay? Remember, these are weighted averages. So it's okay to have a company with a 45 PE. You just don't want lots of them with a 45 PE. We don't even worry about yield. We talk about it like the cherry on top of the sundae or the icing on the cake. This yield is 0.7%. That's a pretty normal yield for a better investing portfolio, less than 1%. Average in the market, less than 2%. Okay? Your financial strength is 84, gold star, and your EPS stability is 81, another gold star. This is a really good portfolio from the report card's point of view. Now, you told me last night at dinner that you have 18 members. Are you aware of how many stocks you have?
Yeah, it should be 15 stocks. I think we should be 15 member banks.
You're right. Most of the time, clubs can't tell me that number, and it's an important number for you to know. You need to know how many stocks are in your portfolio, all right? Because then you can quickly do the math in your head when you need to, or if you need one of these by your side, $9.99, you can buy one and put it right there, okay? 100 divided by 15, I say 6. Keith would say something different. But I say around 6, okay? 6 times 15 is 90, so it's 6 point something or other, but we'll do 6. All right, so how big is too big? 18%. Did that make sense? We didn't talk about how small is too small, but I'll give you a benchmark. Half of an average holding or less is too small. So how small is too small? 3 or less. This isn't rocket science. Anybody, even the person that has been telling themselves for 40 years that they can't do math, even those people can do this kind of math, all right? So let's look at your percent of total to start with. I just clicked on it and I sorted it from biggest percentage. Big news, it's NVIDIA, all right? To smallest percentage. You don't have anything too big, although NVIDIA is moving towards 18, and at some point, you're probably going to have to deal with taking some capital gains, okay? You can't let it become 35 or 40% of your portfolio, because then you're out of control if NVIDIA crashes, all right? You need to have safety markers along the way, guide rails, if you will. Let's look at the bottom of the list. Instead of scrolling, I'll just click again. Here's an issue with some of your stocks. NICE. I own NICE. That's a great company, okay? It's headquartered in Tel Aviv, however, and that's caused it some real problems and really put it on sale. All right. NICE is only 2.5%. My advice would be maybe you need to buy a little bit more NICE or get rid of it, one of the two. Same thing about Tractor Supply, a great company, which Natalie owns in her IRA. See, we like this portfolio because we own some of it. So we're smart, so you must be smart, okay?
We just saw it.
All right. Tractor Supply is a great retailer to have in your portfolio. So are companies, by the way, like Five Below. What's the TJ Maxx, Ross Stores. Those are all really good retailers to put in, but Tractor Supply is a very appealing company to have in. I don't see anything else much smaller to worry about. Let's look at sales growth. That's his company. Mark doesn't even say sales. He just says growth, because we believe that all growth comes from sales, okay? You got some really good fast growers. You got a lot of them past 12. Axos, Nova, Microsoft, Meta, NVIDIA. Excellent. Okay, let's click it again. Oh, you got 4 that you might want to look at for growth. All right. Apple. Oh, I know that's heresy to some people, but Apple, Trex, Generac, and Tractor Supply. These are great companies, all of them. I know Generac, it's just had some real troubles. Okay. But their anticipated sales growth is not helping your portfolio move to the sales growth you need to get the par growth you need to get the return that you need.
Ask you a question right now.
Sure.
So you mentioned Apple was one of the ones. And Apple tends to be in a situation today where it's, as you know, kind of a mid-level sales growth, mid-single digits.
Yeah.
Earnings are double digit.
Yep.
TV primarily do the stock buyback. So how do you factor that in when the sales are not at that double digit, but earnings are there in terms of your?
I would never not have Apple in a portfolio that I had for personal reasons. And Natalie and I have a significant holdings in Apple. It doesn't mean that that's where I would start looking to help my sales growth. Okay, I'd give Apple a pass on this list. I would seriously look at two of these four. Okay, I'd look at Trex and Generac. Okay, but I wouldn't necessarily be that critical of Apple or Tractor Supply, either one. All right. But again, these are your portfolios, not my portfolio. Okay. I don't see anything else that I really want to look at, except I'm going to just take a real gander at quality. I usually don't have to, but I just want to make sure, and you don't have any companies with a quality lower than 60. Okay. That 62 is the lowest, and that just gives me another reason why I might want to look at Generac. Okay. I mean, it has a low par, it has a low quality, it has a low growth. Generac might be where I could gather some cash and then put it into some of my faster growing companies. All right. And, that's $6,000. And in a portfolio that's $166,000, that could move your numbers a little bit. $6,000 can. That portfolio you were looking at from the Mid-Michigan Model Club is $1.7 million. And so $6,000 doesn't move it at all. But $6,000 would probably move your numbers. All right. Model Club, I don't see anything else to talk about. You're doing a fine job. I've given you a couple things to think about. But again, whatever you do, please do slowly and methodically. Okay? Anybody else from a club? Yes, sir.
How much cash? An account that size, would you think?
In $1 million account?
No, in this account.
In this account, I would say that if you held more than 7 or 8% cash, maybe $10,000, $11,000 would be the maximum you'd want to hold at any given time, unless you have specific reasons for holding that cash. In today's market, with today's brokers, you can buy stocks in any amount you want. So it used to be that people would hold cash waiting to get enough money to buy a certain number of shares, but you don't have to do that today anymore. So you can begin a position with fractional shares even if you want to. So I think $10 or $11. How much cash does this portfolio hold? No, you hold $11,900 as of the report that I got. $11,914.67 to be precise.
Tractor Supply in particular.
Well, you still hold some of it.
No, we don't either.
Well, I'm not going to go there. You can figure that out, but I've given you some numbers. Is there anybody in here, a club that sent me a portfolio? Because I want to do the ones where you're here. The Boss Ladies. Okay. I'm going to go back to dashboards, and I've stored your dashboards in Southeast Michigan. And let's see if I can find Boss Ladies in here. Look at this. Boss Ladies, North Carolina. Okay. Okay. On first glance, Boss Ladies' portfolio is matching the market. And that's to be celebrated. You don't beat yourself up when you're not beating by 5. Okay? Boss Ladies has a par going forward of 7.9, and my par is 8.1. And to me, those are the same numbers. Okay? All right. Quality. Your quality is not as high as most better investing portfolios. And when we look at the stocks in your portfolio, people are going to understand, all right? Because you're kind of playful with a lot of your stocks. Am I correct?
Sometimes.
Well, more than sometimes. So we'll look at it, okay? But you still have a quality that I think is acceptable. Your quality is, let's say, 66. I would love to see it above 80. All right. But 66 is above 60. And that's the cutoff where I really start to worry about a portfolio. Okay. Your growth. This is the number that I think you want to really focus on. Your growth is just barely beating the market at 8%. You have 8.4 and the market's at 8.1. All right. So I'd love to see you push that growth at least up into double digits, up into 10, 11 if you could. And how do you do that? You sell stocks growing less than 8.4 and you replace them with stocks growing more than 8.4. Okay? They can be new to the portfolio or they can be ones you already have in the portfolio. PE ratio is 19. That's superb. We don't worry too much about yield. Your financial strength is about above 60, but your EPS stability, the average earnings line on your SSGs looks more like a roller coaster than it does a straight line. And that's something that makes prediction more difficult. It doesn't make prediction impossible. It just makes prediction more difficult. That's all. All right. Let's look at percent of total. Okay. First of all, how many stocks do you have? Do you know? 13. You're right. Great. Okay. Let's look at percent of total. Here's one of the biggest problems I see in this 13 stock portfolio. First of all, how do I find your magic average holding number? I take 100 and I divide it by 13 and I get about 8. Okay? You with me?
Yes.
Okay. So what's too small then? Less than 4, less than half of that 8. What's too big? 24% or more is probably too big. 3 times that 8. Okay? So I'm looking at your smallest holdings. LKQ, an auto, I was trying to find a word for junkyard, but I couldn't. It's basically a junkyard. They sell used parts. 0.1%. Franklin Resources, 0.1%. Comcast, 0.9%. Ford, 1%. Carnival, 2.5%. Air Lease, 2.7%. Air Lease just got bought. You got a really big boost on your Air Lease price, 2.7%. And then we move way up to Clear Secure at about 6%, which is acceptable. So you have 5, 6, 7. You got about 7% of your portfolio in 1, 2, 3, 4, 5, 6 stocks. And no matter what they do, they're not going to really move this portfolio one way or the other. Okay? So your decision really needs to be, we're going to add to some of these and we're going to delete some of the other ones here. All right? How many people in the Boss Ladies?
23.
Wow. So you could boost this portfolio to as many as 16 or 18. Maybe what we need to do, besides looking at the smalls, maybe we need to look at the bigs. Okay? And maybe you need to bring your average number down to somewhere around 5 or 6 rather than the 8 that it is right now. Okay? Which means you maybe need to add some more stocks to them and then get them to be big enough. Now, they could already be in your portfolio. They just aren't big enough quite yet. You haven't added enough money to them yet. All right? But Sprouts is pretty good size. That's almost what's more than a fifth is 22.4% of your portfolio. So maybe there's a place. It has a growth number that's not bad. It's 9% grower. That's better than your average. So, if you replace sum of sprouts with something else, you want to make sure you'd replace it with something that grows better than 9. All right. And I'm looking at the Sprouts has a 99 quality. That's a really, really high quality stock. So maybe you don't touch Sprouts at all. Maybe it's taken off the hot seat for some other really good numbers. Schwab is a pretty good size holding, 15%. And so is Uber at 15%. So those might be places you take a good look at what's going on. Uber has great sales growth. Schwab's growing at 9 as well. Schwab has a pretty good quality at 76, but Uber has a 30% quality, and it only represents 7/10 par going forward. It does have good growth, but that good growth right now is not helping the portfolio because it's only 7/10 of the portfolio. It's a wonderful tree, but there's so many other trees in the forest that we can't even see it. All right. Again, I've given you just some ideas. Whatever you do, please, slowly and methodically. Do not draw blood in your portfolio, okay? I've had the experience with a club where they went home and sold almost everything and then didn't know what to do next and called me. Okay, so I don't want to hear from you in the next 2 or 3 months. I'll take an email, but no calls, okay? All right. Let's look. Is another club that's in the room? PPP. I know that I have yours as well. So we'll go back to dashboards. We'll look at Southeast Michigan, and we'll try to find PPP.
There you go. Perfect Partners with Profit.
There it is. Okay. And let's look at your par. Well, your par is 7.2, and that is different than the 8.1 my par number. So you're not quite up to the market. And with a par at that level, I would assume your growth is not going to be up around 12 or 13, and it isn't. Your growth is just over 10. Now, your growth is really not terrible, but I would give it a B- right now if I were giving you a grade on it, okay? I'd love to see you up around 12 if you could move it up in that direction. Let's look at some of the slower growers, okay? And again, oops, wrong column. Here we go, slower growers. And how many stocks do you have? Do you know?
17.
17. So your number is, golly, in my head, your number is about 4. 17 times 4, will that do it? No, it won't. 5, 6, 60. There we go. Your number is about 6, okay? That means that Williams-Sonoma and Procter & Gamble might be a little bit on the small side for this portfolio. Okay, I'm looking at the rest of the numbers for Williams-Sonoma. Growth, look at the sales growth number for Williams-Sonoma, 1.7%. And it only represents a par of 0.6%. Here's a way to raise $20,000 and put it into faster growing companies where you can increase the par, where it will influence the portfolio. Okay? This company is not going to influence the portfolio positive with a 6/10 par. Now, Procter & Gamble has a better par. I own Procter & Gamble. I understand why you might want to own it. Okay, but it's in our one portfolio that we call the old fogies portfolio. All right, and it's there because if everything else fails, we feel people still need toothpaste and Tide. Okay, so that's why we own Procter & Gamble. A club usually isn't making those kind of considerations for their portfolio. So I don't see Procter & Gamble's growth 2.8, and that might be generous. Their par number around 6%. That's probably pretty accurate for this company going forward at 6%. Okay, so and there's another 6,000 because they don't represent very much of the portfolio either. So I'm just suggesting that the growth numbers for those two companies maybe are a little bit low for you to not consider them for a sale at some point. And then, I'm looking at your small companies. Then you could put some more into, you have a whole slew of companies that are under 4% of the portfolio. So you have lots of choices to pick the ones that are growing quickly. You like Palo Alto Networks, so do I. You like Kinsale, so do I. You like Taiwan Semi, so do I. You like NVIDIA, so do I sometimes. You like CrowdStrike, really, really, I like that one a lot. So you have companies, but you want to balance them, and whatever you do, again, slowly and methodically. Your quality is great. Don't mess the quality up in the rush to sell things. Your growth could be better. Your PE ratio's a little bit on the high side, which means that you have some frisky companies in here. Okay, so kind of watch how frisky you're going to get. If you push that up into the mid 30s, you might be taking more chances than you'd like to take. Your financial strength is excellent. Your EPS stability is very, very good. So that gives you a little bit of direction as to what you might consider. Please, slowly and methodically, whatever. Do we have any other clubs in the room that I did a portfolio on? Okay, then that last one, we're just going to, they're not on, what is this thing called? Zoom. They're not on Zoom, are they? The other club?
I have Women on the Move Investment Club.
So I've left about 8 minutes for questions now, and I'll go almost anywhere about what I talked about, and almost anywhere as long as you stay in the investing realm with outside of what I talked about. So let's answer a few questions before Natalie and I get on the road to Richmond. Yes, ma'am.
So I don't understand the par value. Can you explain that again?
Sure, it's just like the par on your SSG. It tells you the potential annual return for the next 5 years. So your portfolio, based on the analyst community, because Manifest is completely based on analyst data, not your data, okay? Before you would do anything, as I said earlier, I would want you to validate what Manifest says about a company with what you think about a company on your SSG. They should be roughly in line with each other. Now, they're not going to match exactly ever. You know, Manifest might say par of 12 and you might say 12.7. That's the same number. Manifest might say 11 and you might say 9.9. That's still the same number, okay? So they just have to kind of validate each other in the general ballpark. All right. Manifest is based, it was based when I spoke to Raleigh on Y charts. Y charts has become very unreliable with the data, and we have now moved to value line data, which is the cream of the crop. Mark's paying a little bit more for it, but it's worth it. The value line data is just spot on all of the time. And we're just very, very happy with the value line data. So that's the data source coming for this spreadsheet. Validate it with your own stock selection guides before you do anything. That's part of the slowly and methodically, all right? So right now, we would expect, if all of the data analysts were correct, we would expect next year to see your portfolio increase for this portfolio about 7%. And then the year after about 7%, and every year for 5 years, approximately 7%. All right. This number will change as the stocks in the portfolio change. This number, the report card's not static. It changes monthly. Even if you don't change the stocks, the report card changes, depending on how the stocks do and depending on how the analysts feel about how they're going to do. All right. Another question.
There was on the Zoom, there's a portfolio Women on the Move I think they wanted to get.
Okay, let's see if I have women on the move. That sounds familiar to me. Let's look. Look at that. There it is right there. Okay. Okay, women on the move. I don't see you, but I'm talking to you. Your par value for this portfolio is only around 6, and the market's par is around 8. Okay. Your quality is excellent. Your growth, however, is where I would start doing some work. Your growth is only 8%, and I would start to look at companies growing slower than that and considering them for removal, and then looking to add companies that are growing quicker than 8. I'd love to see that in double digits within the next 2 years, okay? Slowly and methodically. I said 2 years, not 2 months. You can't make this happen overnight, all right? Your PEs are fairly reasonable. Your financial strength and earning stability are really good. Let's look at your 2 smalls. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 companies. So let's say 8 is your magic number. And when I do percent of total, I find 1, 2, 3, 4, 5, 6 of them might be too small. All right, and that would include American Airlines, Chipotle Mexican Grill, Ford, Exxon, Amazon, Alphabet. I guess as a personal note, I would question why Ford belongs in anybody's portfolio. And I'm not sure that airlines are good, high-quality growth companies. Airlines are trading instruments in my mind, and they're the kind of people that buy airline stocks are the kind of people that might sell them 2 weeks from now and might buy some other airline 3 weeks from now. I noticed that you not only own American Airlines, but you own, I thought you owned 2 airlines. Maybe I'm incorrect. I'm incorrect. I'm sorry. I thought I saw 2 airlines on here, and I don't. Okay, so I would put Ford and American on the chopping block to start with. I think Chipotle Mexican Grill is a wonderful company, and I think it might even be a buy at the present prices. Again, do your own stock selection guides. I do not dabble in energy at all. I just don't understand the energy cycle, and I've been unsuccessful every time I've tried to move into energy. And so I remind myself, I do not need a stock from every sector. And energy is a sector, and I don't need an energy stock. So I don't even deal with energy. I think Amazon is a wonderful holding for anybody's portfolio. It has growth at 11% most recently and a par at around 10. I think Amazon could be characterized as the core of a lot of people's portfolios. Amazon, Google, Microsoft, companies like that could be characterized as the core of modern portfolios, at least for the last 3 or 4 years now. That might change in 2 or 3 years, but right now I think those are the companies that you want to have in your portfolio in addition to a lot of others. I see that Alphabet is only 3.8, but it has a sales growth of 11 and a par of 6.5. I wouldn't raise Alphabet to an 8, but I certainly think you might consider watching Alphabet. Remember that a week ago, before the federal courts said that they were not going to break up Alphabet, Alphabet was an extremely attractive buy. Alphabet's gone up about 25, 28% now in about a 1 week period because the courts said, we're not going to break you up. We might ask you to do some other things, but we're not going to break you up. And that sent the stock soaring. Natalie and I like that because it's one of our largest holdings, but it has a par now that's not particularly attractive. So women on the move, I think that there's some things you can do. This is a relatively small portfolio at $337,000. And I still think you could move it fairly easily by making some not huge changes in the portfolio. Again, look at your biggest holdings, look at your smallest holdings. I guess I want to speak about your biggest holding, and maybe you have to bite the tax man bullet. O'Reilly is 32% of your portfolio. That's 1/3 of your portfolio. And the way O'Reilly goes, so goes your portfolio. And O'Reilly's par right now is 2.5%. Okay? Its sales growth is estimated to be around 7%. So it's a wonderful, wonderful company. And it's made my clubs and me personally a lot of money, but I don't think it belongs as a 32% holding in your portfolio right now. I'd consider taking some capital gains, even though that might be painful. How many members does this club have? Do we know?
We're down to 8 now.
Then if you only have 8 members, and I did hear that, I don't know how I heard that here, but you have 8 members, and this might be a little bit ambitious size of a list for 8 members as well. You might consider getting it down to maybe 11 or 12 stocks for 8 members.
Okay. All right. Thank you for the feedback.
One more question, and then Natalie and I are on the road. Yes, sir.
Quality. What
Hi.
used to give the quality score?
I'm not going to give you an answer, but I'm going to tell you to do this, okay? Go to the manifestinvesting.com site, all right? Or go to a search engine and search Manifest Investing and then use the word excellence. On a Google search, what will rise to the top of the search is an article on Manifest Investing about how quality is calculated. I'm going to tell you what the 4 principles of quality are. It's based on 4 things. First, sales growth in relation to the rest of the industry. Make sure that's clear to everybody what that is. Second, earnings per share, profits in relation to the rest of the industry. Thirdly, profit margins compared to the industry. And fourthly, financial strength compared to the rest of the industry. Now, each one of those 4 gets 25 points. So when you look on a company, I'm going to show you O'Reilly Automotive here. This has a quality of 90 up here in the top of the screen. Do you see it? Okay. I'm scrolling down the screen. And again, you can get a free trial for 3 months. Just go to manifestinvesting.com and ask for a free trial. Okay. It's a button. And I'm looking at the 4 qualities right here. Financial strength, it gets 11.5. If it had average financial strength, it would get a 12.5 out of 25. That's halfway between 0 and 25. If it would have had excellent financial strength, it would have gotten a 20 or 22 or 23. You still with me? Okay. The next pillar is EPS stability. How straight is that earnings line? Okay. And they're in the 97th percentile. That's pretty good. And therefore they're getting 24.2 out of the 25 points that can be allotted. You still with me? Okay. Third quantity. Their sales growth is, what is their sales growth up here? Sales growth forecast, 7.3. The industry has a sales growth forecast of 7. So they're pretty average. And they should get somewhere around 12.5 points. They're getting 13. Okay? The profit margin for their industry, their profit margin is 15. The industry's profit margin is 8.5. 15 is a lot better than 8.5. They should get closer to 25 points. They're getting 22 points. Okay? I add these 4 scores together and I get 70.9. Now, if you're into statistics, this is called the raw score. Then you take all the raw scores from all the companies in the database and you put them into a quintile scaling. And we find out that that raw score is better than 90% of the companies in the database. That's how quality is finally calculated. I told you what it's based on. That article will explain it further. And then I told you how it's calculated. Okay? That's all for today. I've really enjoyed this session. This is a really smart audience, by the way. You need to know that. And believe me, I have lots to compare you to. So this is a really smart audience. And I'm pleased to talk to you, okay?